So we are to start on the financial business. So I will take a brief time to go through the handout for the financial business. We shall take a short period to go through the handout for the financial distress. So when you check that handout for the financial distress, the explanation is simply that it refers to the events. It refers to the events that occur when the company is facing some financial difficulties or problems. So I've listed some forms of the financial distress. I've listed some forms of the financial distress. Then I've also given you types of the financial distress costs, where we have direct and indirect. So those ones you will read. I've also given you indicators of the financially distressed companies, then also option at the time of the financial distress. And I've also given you the causes of the financial distress, why the company will fail financially. So go through them. Those ones you may not get enough time to discuss each step by step. So what I will do today, I want us to have that part of models of predicting the corporate failure. So in your books, we can have a subtopic as models of predicting the corporate failure. So in your notes, I want us to write something brief on the models of predicting the corporate failure. So let us now look at the models of predicting the corporate failure. So I will go direct to those that are mostly examined. So there are several in the handout, but I want us to start with the first one, which is indicated as number 9. I want us to start with the first one, which is indicated as number 9. So that model, when you check through the notes, it has been indicated as the Springkett score. So one to check. So that will be the first model, which I want us to discuss about models of predicting the corporate failure. We are now looking at the models of predicting the corporate failure. So that model, when you check through the handout, they are saying that it was developed by Gordon in 1978. So this model selected 4 common financial ratios. It selected 4 common financial ratios, common in the financial ratios, to determine the likelihood of the firms failing. So this model also uses the stepwise discriminative analysis to result in the score for each specific company. So companies with a Springkett score of lower than 0.862 are classified to have done what? To have failed. So that's now the Springkett model. Any moment you calculate that the score, you get 0.862, that company would have failed. So I will go direct to the model, whereby they gave you the model as Z. So Z is supposed to refer to, so Z is meant to be equal to 1.3, 1.03A, 1.03A. Then we add 3.0, 3.07B. Then we also add 0.66C. We also add 0.4D, like that. So that's now our Springkett model. So we shall be able to have it in that manner. So that is the model which is there in the handout. Yeah, we are not doing any question. We are discussing the handout. I had asked you to prepare the financial distress. When you go to the model number 9, that is where we are in the notes. So when you go through that part, they were able to say that where A simply means working capital divided by the total assets. Then B simply refers to earnings before interest and tax. You also divide by the total assets. Then C is earnings before the tax. Then we divide by the current liabilities. Then where D is meant to be the sales, then you divide by the total assets. So that is one of the models we normally apply to determine whether the firm will be successful or it is going to fail. So there is a question in your past paper on that model, which we want to go through to see how to measure whether the company will fail or it will be successful. So that question is in December 2021. When you check December 2021, there is a question number 3, part C. When you go to December, you want to go through the question for December 2021. Question number 3, part C. Question number 3, part C. Question number 3, part C. You want to go through the question number 3, part C. That question 3, part C, it should be on page 6. When you go to page 6, we have that question of the sprinkled model. So the question reads that the following data relate to Company Limited, a company that operates in the manufacturing sector for the year ended 31st December 2020. For the year ended 31st December 2020. You are given the sales. You are also given total assets, total liabilities. You have also been given retained earnings. Then net working capital. They also gave you about the earnings before interest and the tax. You are also given market value of equity. There is also book value of the total liabilities. So the company is currently paying interest on the long-term debt instrument amounting to shillings 905,000 per year. And that the company's total liability is considered in the ratio of 2:5 between the current and non-current components. So required, using the sprinkled model, assess the financial health of the company. Not that the model has been given, they have also specified the information in relation to that. So in the notes, I've given you the index. That index in the notes, it is 0.862. So in case it will be more than 0.862, that company will be successful. It is successful. But if it will be less, then the company will have done what? It will have failed. So the index we are looking for is the 0.862. Then from there, we shall be able to tell. So the question was meant to give you 9 marks. There are 4 ratios we need to compute. There are 4 ratios we need to come up with. So we start with the A. We start with the ratio A. So A, when you check through the question, A is supposed to be net working capital. We divide by the total assets. So A is simply the working capital divided by the total assets. So we go through the information given. What is the working capital? When you check through the question, they gave you the net working capital, which is a negative figure. You can see that net working capital. One might prepare negative what? So there are 3 zeros at the top. That figure is the same as 1.777 millions. So it is given as 1.777 millions, but the figure is negative. Then you are supposed to divide by the total assets. So total assets were given. Are you able to see the total assets? It is 49 point what? Yeah, so it is meant to be 49.579. So that figure don't divide. Just have it like that. You reuse them directly in their model. So because if you compute and round them off, they will change the results. So there are 4 ratios. And if you round the 4 of them, they will be able to make a change in the. So what you do, we just identify what is A, what is B, C, and D. Then we shall apply them directly in the model at that portion. So that's now A. So we also need to come up with B. We also need to come up with B. So B, they have indicated that B is meant to be operating profit divided by what? Total assets. So operating profits is the same as earnings before interest and the tax. Then you divide by the total assets in that manner. So earnings before interest and tax. Are you able to see the figure in the question? It is 2 point what? So it is 2.605. Then total assets, we know it is 49.579 million. So that's now the value for B. That's meant to be the value for B. The next item we need to compute is supposed to be C. So C, they have said it is what? Net profit before the tax. We divide by the current liabilities. It is the same as earnings before the tax divided by the current liabilities. So both of them have not been provided. So the 2 of them have not been given. So we need to come up with that. So we start by computing earnings before the tax. We want to get the earnings before the tax. So to do that working, the question has given us earnings before interest and the tax. You can see the earnings before interest and the tax. It is 2.605 million. But when you continue the question, they had given you some details that down there. The company is currently paying interest on the long-term debt instrument amounting to how much? 905. So we minus interest. Once you get the earnings before interest and tax, we need to less interest. So that interest was given to you. The interest was given as 0.905 millions. 0.905 millions. So that you get now the earnings before the tax. So that we come up with what is supposed to be our earnings before the tax. So what should be our earnings before the tax? 1.7 million. So the other item that we are lacking is the current liability. We need also to compute the figure for the current liability. We also need to come up with the value for the current liability. So to come up with the current liability, there is some more information given in the question. So when you check at the end of before required, you are told that after the interest, they say that under that the company's total liability is constituted in the ratio of what? 2:4. 5 between current and non-current. Between the current and non-current. So current liability, there is current liability against long-term liability. Long-term liability. So current liability against long-term liability, the ratio is given as what? 2:5. That means when the current liability are 2 times, the long-term liability should be 5 times. So then the question has given me the total liabilities. Are you able to see the total liabilities? So total liabilities have been given. Tumepewa a figure of 5 points. Are you able to see 5.044 million? That is the total liability. So we want to get the current liability from that ratio. So current liability, you simply take 2 divided by 7 because it is 2 plus 5. So to get the current liability, it will be the proportion of 2/7 multiplied by 5.044 million. So that we get now our value for the current liabilities. So that we come up with the value for the current liabilities. We get the value of the current liabilities. So how much will be now the value for the current liabilities? 1 point. Like that. So once you have done that, now you come to this point, you get your value of C. We can now get our value for C. So value for C will be 1.7 million. We divide by 1.441 million. So that's now the value for C. The other item we need to compute is D. The other item we need to calculate is meant to be D. So D, the question has specified. It is the sales divided by total assets. You simply take the sales divided by the total assets. So sales were given in the question. It is 25. It is 25.678 million. Total assets, we know it is 49 points. So we have now specified those ratios. So once you have specified them, we go to the model. Once we have specified them, we now go to the model, whereby Z is going to be 1.03 multiplied by A. So A, it is meant to be negative 1.77 divided by 49.579. Like that. So you have that. Then we also add. So 3.07B. So B, we got a figure of 2.605. Also divide by 49.579. Like that. Then we also add 0.666. So C, it is 1.7 million divided by 1.441 million. Like that. Then finally, we go to the last one, which is D, which is 0.4 D. So D, we had already calculated that. We have already specified D. So D is meant to be 25.678. Also divide by 49.579. So combine them together. Your calculator has the capacity to do that. Round off the final figure. If you round each ratio separately, it will change the results. So combine them on your calculator and get the final value, which you round it off to 3 decimal places. You get the final value, which will be rounded off into 3 decimal places and come up with a value for that. So you can round it off to 3 decimal places because the ratio you are looking for, it has 3 decimal places. Anyone who has computed to give me the figure? Anyone who has computed to give me the value? Online, you give me your figures. So I can see 1.110. Yeah. So what does it tell us? We are comparing with the index of. So this one is 1.110. But we compare with 0.862. So the note in the notes, I've given you the standard. The standard in the notes is 0.862. So in case it is less than 0.862, it will indicate that the company has failed. But now that index is more than 0.862. So we can now make a conclusion. We can now make a conclusion on that. That since the index is greater than 0.862, since the index is greater than 0.862, then it indicates that the company is successful. Then it indicates that the company is successful. Then it indicates that the company is successful. So that is what we can get from that question. That is what you can be able to come up with in that particular question. So that company is successful as per the score. So you are getting 1.10. So that's now the question on that spring gauge score. So that's now the first model I wanted us to discuss as per the notes. Then after that, I want us to go to the second model. I also want us to check now the second model. I also want us now to go to the second model. So number 2 that we shall be discussing. So number 2 should be we shall now be discussing the Altman Z-score model. Number 2 will now be the Altman Z-score model. So let us write something on the Altman Z-score model. Remember, it is also a model that we shall be computing some ratios in order to determine whether the firm will fail or it will be successful. So let us write something brief on the Altman's model. Let us now write something brief on the Altman's model. We can now write, it is not there in the handout. This one is a separate model. I want us to write on. So the words I've given you in the handout, mostly they are a theory which you'll be able to read. So the ones I'm discussing, you are writing, these are basically computation. So under the Altman Z-score model, we can write that, we can summarize that. This model combines various ratios. This model combines various ratios in order to determine whether the company is a going concern. In order to determine whether the company is a going concern. In order to determine whether the company is a going concern. And it is normally expressed as follows. And it is normally expressed as follows. And it is normally expressed as follows. So Z will be equal to 1.2 x1 plus 1.4 x2, then plus 3.3 x3. Then we shall also add 0.6 x4, and we also add 1.0 x5 like that. So that model is meant to be, the Z-score will be equal to 1.2 x1, 1.4 x2, 3.3 x3, 0.6 x4, 1.0 x5, where x1 is simply equal to net working capital, net working capital divided by the total assets, where x1 will be equal to net working capital divided by the total assets. Then x2 is equal to retained earnings divided by the total assets. Retained earnings divided by the total assets. Retained earnings divided by the total assets. X3 will be equal to earnings before interest and tax. Earnings before interest and tax, also divided by the total assets. Total assets. Earnings before interest and tax divided by the total assets. Then X4 is meant to be equal to market value of equity. Market value of equity. Market value of equity divided by total debts. Total debts. Right? So market value of equity, we divide by the total debts. And finally, X5. X5 will be revenue. X5 will be revenue. We also divide by the total assets. Also divide by the total assets. So X5 is meant to be revenue divided by the total assets. Then another paragraph, we also note that Altman concluded as follows. Altman concluded as follows. Altman concluded as follows. Altman concluded as follows. So the first dash, we shall say that if the Z score is greater than 2.7, if the Z score is greater than 2.7, then it indicates success or non-failure. If the Z score is greater than 2.7, then it indicates success or non-failure. It indicates the success or non-failure. The second dash is that if the Z score is less than 1.8, if it is less than 1.8, then it indicates failure. If it is less than 1.8, then it indicates failure. It indicates failure. The next dash is that if the Z score is between, if it happens to be between 1.8 to 2.7. So if it is between 1.8 to 2.7, then it indicates 50% chance of success. Then it indicates 50% chance of success and 50% chance of failure. It indicates 50% chance of success and a 50% chance of failure. So we can check a question, November 2020. Check November 2020, question number 1, part B. November 2020, question number 1, part B. November 2020, you check on page 17. You check on page 17. On page 17, there is a question number 1, part B. There is a question number 1, part B on page 17. So that question 1, part B, November 2020, there is a question number 1, part B, where they have stated that Professor Edward Altman's model for prediction of the bankruptcy is given as follows. For the prediction of the bankruptcy is given as follows. So Z is meant to be equal to 1.2x1. They add 1.4x2. They add 3.3x3. They also add 0.6x4. Mine, I rounded it off, 1.0x5. But for them, they have given me 0.999x5. So x1, x2, x3, x4, and x5 are financial ratios, which according to Professor Altman, have the discriminating power, where x1 is meant to be net working capital divided by total assets. X2, retained earnings divided by the total assets. X3, operating profits divided by total assets. Then X4 is meant to be market value of equity divided by book value of debts and preference share capital. So that element of X4, you see the total debts. Yeah, preference shares are normally regarded as part of the long-term debts, according to the Altman model. So when you will be getting the book value for the debts, remember to add the long-term debts and the preference share capital. So always remember that preference shares are a part of the long-term liabilities of the business. Preference shares are a part of the long-term liabilities of the business. That's now how we shall be dealing with that region. Then also X5 is meant to be the sales, also divided by the total assets. So given below are the summarized financial statement of Alpha Limited for the year ended 31st December 2019. So you have been given income statement. You have also been given statement of the financial position. Then they also say that in this model, a Z-score of 2.7 or more indicates no signs of failure, but a Z-score of 1.8 or less will indicates that there is signs of failure. The firm's ordinary shares are currently trading at shillings 1 at 15 shillings each. So required Z-score for Alpha Limited. They also want you to come up with you to comment on the results. So the first thing you need to identify what is X1, X2, X3, X4, and X5 before we include them in the model directly at that point. We get X1. We start with X1. X1 is meant to be the net working capital divided by the total assets. So working capital is simply current assets minus current liabilities before we divide by the total assets. So working capital, so X1 is the working capital divided by the total assets. Working capital, you get the current assets, you minus the current liability. So we go to the statement of financial position. Are you able to see under the assets? There is the current assets, which is given as how much? There are 3 zeros at the top. It means it is 100 millions. It is 100 millions. When you check under the assets, they gave you non-current assets, which are 300 millions, but there are 3 zeros at the top. Then after that, there is the current assets, which are 100 millions. Then go to the element of the total current liabilities. Are you able to see the total current liabilities? They gave you a figure of how much? 20 millions. So they have been given you the value. So we minus the 20 millions before you divide by the total assets. So total assets were given. Total assets are 400 millions. So which means this figure will be the same as 80 millions divided by 400 millions. That is now our X1. That will be now our X1. So we also identify, so we agreed we don't divide. You apply them directly in the model because we are simply looking for 1.8 and 2.7. If you round off the 5 ratios, they will change the decision. So what you do, first of all, get each X1, X2 separately, Then we shall go back to the model. We apply them directly because our calculator has the capacity to do that. So we now go to X2. We check X2. X2 is simply retained earnings. It is the retained earnings also divided by the total assets. So retained earnings, you take the one in the statement of the financial position. Don't take the retained earnings of the income statement. The one for the financial statement is for the current year and the previous periods. But the one in the income statement is just for the current period. So we check the one in the statement of the financial position. So in the statement of the financial position, what are we given as the retained profits? You can see under financed by, it is 120 millions. You also divide by, is it 400 millions? So that is now our X2. We also identify X3. So X3, as per the information given, it is meant to be earnings before interest and tax, also divided by the total assets. So in the question under the income statement, are you able to see the operating profits? How much is the operating profits? Yeah, so earnings before interest and tax is the same as the operating profits, where the question has given you 14 millions. We still divide by 400 millions. Then we also identify X4. We also identify what should be X4. So X4 is supposed to be market value of equity. Market value of equity. We divide by the total debts. Divide by the total debts. So market value of equity, we simply take the number of the ordinary shares multiplied by the current market price per share. So in the statement of the financial position, are you able to see the ordinary share capital? In brackets, 10 shillings each, total amount is how much? 100 million. So to get the number of the ordinary shares, take the 100 millions, divide by the bar value per share, which is 10. So that will give you the number of the ordinary shares. Then when you check before required, they say that the firm's ordinary shares are currently trading at how much? Before required. You can see the 15 shillings each. Yeah, so we take the number of the ordinary shares multiplied by 15 shillings. That will give you the market value for equity. It will give us the market value for equity. So when you take that and multiply by 15, how much is the market value for equity? Sorry? 150 millions. So this will be 150 millions. Then total debts, we have said that it is meant to be the debenture capital. You can see the debenture capital. Debenture capital is how much? It is 80 million. Then you also add the preference share capital. You can see also the preference share capital. It is how much? The 12% preference share capital is 40 million. So add 40 millions so that we also get now the total debt. So total debts, it is the long-term liabilities plus the preference share capital. So inakuja ngapi hiyo? 120 millions. Then finally X5. So X5, it is supposed to be the sales revenue divided by the total assets. It is the sales revenue divided by the total assets. So sales is given as 400 millions. Then total assets are also 400 million. So once you have done that, we now go to the model. Z is supposed to be equal to 1.2 x1. See, x1 we saw it is how much? 80 millions divided by 400. You go to the next one, which is 1.4 multiplied by x2. Our x2 was 120 millions divided by 400. Then 3.3 x3. Our x3 is meant to be what? 40 millions, also divided by 400 millions. Then we also have 0.6 x4. So our x4 is 150 divided by what? 120. Then finally, we use the one given in the question. The question is 0.99. So 0.99 x5. Your x5 is 400, also divide by 400 like that. So combine them in your calculator and get the final value. You round off the final value like that. So you can have a short break. Then after that, we shall resume from that level. So online, I've seen a figure of 2.739. So are we all getting that value? So it is 2.739. So I can see a figure of 2.739. But our concern is to know about 2.7, isn't it? Yeah, so we can now make a conclusion in the Roman letter 2. So Roman letter 2, they were asking you to advise, or they wanted you to comment on the results. So we can just comment that since the index is greater than 2.7, since the index is greater than 2.7, then it means the company is successful. Then it means the company is successful. Then it means the company is successful. So one more question on that. I want you to check December 2014. December 2014, question number 3. Part A, December 2014, question number 3, part A. We can now check December 2014, question number 3, part A. December 20, so you check on page 69. When you go to page 69, there is a question number 3, part A. So let us go to page 69. They have given you some details about the question number 3. So we can go through the question, which reads that the following are the summarized financial statement of Shinda Products Limited, which is facing financial difficulties. So income statement for the year ended 31st December 2013 is given. So turnover will be the same as the sales revenue, earnings before interest and tax up to the end. Then they have also given you statement of the financial position. Then after that, additional information, note 1. Tax rate is 30%. Note number 2, shares are currently trading at 30 per share at the Securities Exchange. The cost of capital is 12%. Then interest rate on the bank loan is 12%. Altman's model for predicting the corporate failure is as follows. So for this one, the last one that we used 1.0, but the other question was 0.99. So they normally interchange in that order. They can round them off. So they now required, they gave you the explanation for X1, X2, X3, and also X4 and 5. Then required the company's Z-score. Then also you are to comment on the results. So we simply identify X1 up to X5. Then we go to the model in that order. So let us identify what is meant to be X1. You want to identify what should be X1. So you have said that X1 is simply the working capital divided by the total assets, which is the same as current assets minus current liability divided by what? Total assets. So let us go through the question. Let us check under the statement of the financial position. Under the statement of financial position, are you able to see the current assets? There is inventory, trade receivables, and also the bank balance. So that total they have given us 300 and what? You can see the 375. Yeah, they have added the three items together to give you 375. So 375 millions. We are supposed to subtract the current liabilities. We are meant to less the current liabilities. So current liabilities, also check in that statement of financial position. You can see the current liabilities. There is the trade, payables, taxation, and dividend. That total has been given as 420. So you minus 420 millions. Then total assets were given. Are we able to see the total assets? Total assets are 1266. It is 1266 millions. So this will be the same as what? 375 minus 420. 375 minus 420, negative what? Negative 45. So also divide by 1266. So that is now our X1. That will be our X1. Then we want to identify X2. We also want to identify what is meant to be X2. When it comes to X2, it is the retained earnings divided by the total assets. Retained earnings divided by total assets. So retained earnings, we say we use the one of the statement of the financial position. Retained earnings, we use the one for the statement of the financial position. So are you able to see the retained earnings before the current liabilities? They have given us 222 millions. So it is 220. So you still divide by 1266. So that is now our X2. So we also need to identify our X3. We should also come up with X3. X3 is simply earnings before interest and tax divided by the total assets. So earnings before interest and tax is the operating profit where they gave you in the income statement. That figure is 84 millions. So total assets are still 1266 millions. Then we now also want to identify X4. We also want to come up with X4. We also want to come up with X4. So X4 is market value for equity, also divided by the total debts. So market value for equity, identify the number of the ordinary shares. You can see ordinary share capital in brackets is 25 shillings each. Total figure is 140 what? 147. So take 147 millions divided by the bar value, which is 25. So go to the note number. Are you able to see the note number 2? The company shares are currently trading at how much per share? 30. So we multiply that by 30 so that we get market value of equity. We come up with the market value for equity. So market value for equity will be the same as which figure? 176 point. So we also identify the total debts. So this time the question has no preference shares, but you can see under the long-term liabilities. Bank loan is given as how much? Bank loan is given as 183 millions. Are you also able to see the 10% debentures? 10% debentures is given as 200 294. So when you add them together, they should give us a total of which figure? 477 minutes. Then for X5, they gave you the turnover. Turnover is what will be representing the sales. Turnover is what is supposed to be the sales. So that turnover, they gave you 1209. They were able to give you 1209. Then we also divide by the total assets, which we know it is 12 what? 66. So now after that, we go to the model. We now go to the model to get the Z score. We now go to the model to calculate our Z score. Now come to the model to compute the Z score. So Z score is going to be, so our Z score should now be 1.2 x1. So our x1 should be -45 divided by 1266. Then we also add 1.4 multiplied by x2. So x2 is meant to be 222. Also divide by 1266. Then also 3.3 x3. So x3 is 84. Also divided by 1266. Then there is 0.6 x4. So that x4, it is 176.4 divided by 477. Then finally, there is also 1.0. So x5 is 1209. Also divided by 1266. So this time it is giving us each 1.59. So we can just round it off as 1.6 because we require it in the 1 decimal places. Then we are looking for 2.7 and 1.8. We are looking for 2.7 and also 1.8. So when you round it off into 1 decimal places, we have it as 1.6. So obvious, it is less than 1.8. Yeah. It is less than 1.8. Online, you are getting which figure? Online, you have not given me your index. You are getting which index online? So 1.599, because we are looking a figure which is in 1 day. We are looking for 2.7 and 1.8. So that figure is less than 1.8. So now the advice is that Since the z-score is less than 1.8, since the z-score is less than 1.8, then it indicates that the company will fail. Since the z-score is less than 1.8, then it indicates that the company will fail. Then it indicates that that company will fail. So that was the advice, where the question required you to calculate the z-score and also comment. Then, still in that question, you can see the part B of the question. So part B, they have said that other than the Altman's model, evaluate 4 other ways of predicting the corporate failure. They wanted you to evaluate 4 other ways of predicting the corporate failure. These are not in our pair. These are not Mukonazo. You can see in the handout. In the handout, I gave you other models. You can see those other models on page 2. When you check on page 2, I've given you other models of predicting the corporate failure. So you can see there are how many? No, there are 9 other than Altman. There are 9 of them. Other than the Altman, there are 9. So you read them. You read those models. Then, now you will also refer to the question. Also, I want you to refer to the question for so I also want you to check the one for May 2015. Also, so that should be on page 66. On page 66, there is a question for May 2015, question 1, part A. May 2015, there is a question number 1, part A. So that question 1, part A on page 66. When you go to page 66, question 1, part A, evaluate 4 limitations of the Altman's Z-score model for predicting the corporate failure. Even that one I've summarized for you in the handout. When you check at the end of the handout, the last page, I've given you limitations of the Z-score model. So go through those limitations of the Z-score model. You go through the limitations of the Z-score model. So that is now all about the financial distress. The handout you read. But before that, let us also look at the applications of the Z-score model. Let us also write something brief about applications of the Z-score model. We can now look at the applications of the Z-score model. The applications of the Z-score model. So under the applications of the Z-score model, number 1 would be that to evaluate the performance of the company's managers. Number 1 would be that to evaluate the performance of the company's managers. To evaluate the performance of the company's managers. The number 2 would be to predict the corporate failure. Number 2 will now be to predict the corporate failure. Number 2 will be to predict the corporate failure. Number 3 will be, number 3 is that to determine whether the company is a going concern. To determine whether the company is a going concern. To determine whether the company is a going concern. The last one is that to determine whether the company can enter into the strategic alliance or mergers. To determine whether the company can enter into the strategic alliance or merger. To determine whether the company can enter into the strategic alliance or merger. to determine whether the company can enter into the strategic alliance or mergers. So you will go through the handout in that area. So after the financial distress, here your pair notes for the bond refunding. Here your pair notes for the bond refunding or refinancing. I also gave you your pairs for more. Sorry? Yes. Yes. I give you the range of the ratio in the max. When it is 2.7 and more, it is successful. When it is 1.8 and less, it has failed. You can see the notes. When it is 2.7 or more, it means what? It will be successful. Then, when it is 1.8 and less, it has failed. So the first one we got 2 point. Yeah, even more than 2.7. Yeah, so any moment the Z-score is more than 2.7, that company will be successful. But any moment it is less than 1.8, the company will fail. But if it happens to be in between, there is 50% chance of success and 50% chance of failure. So that's the standard. So you have the notes for the bond refunding. So we say that after finishing those a bit wider topics, the ones remaining are shorter ones. We can even discuss 3 of them in our lesson. So let us go to the bond refunding or refinancing. We can now check the bond refunding or refinancing. So when it comes to the bond refunding or refinancing, sometimes we normally borrow money from the bank. Then we repay before the maturity period. And probably you borrow afresh. So that process of repaying before the maturity period, and maybe you borrow again, is what we refer to as refinancing or refunding. So that's now the general explanation for the refunding or refinancing. You repay before the maturity period, then you get a new loan facility. So for this case, the reason could be the market interest rates have declined. You borrowed when the rate was high, but now it has gone down. So the best way is now to repay that money in full and borrow afresh at a lower interest rate. That's now the refunding or refinancing. Then sometimes you can be in a better financial position. Probably you borrowed when you are having financial crisis, but now you have the finances. So it is better to repay so that you avoid paying the interest. So that is what we shall be explaining as the bond refunding or refinancing. Then I've given you reasons for refinancing or retiring the existing bond. There are 5 of them. So take time, you go through them. Then I've also given you some key terms in relation to that. There is the call premium, discount on issue of the new bond, issue of the flotation cost. They have also talked about overlapping interest. So all of them are just going to be explained from the question point of view. So I want you to check now a question, November 2019, question number 4, part C. November 2019, there is a question number 4, part C. November 2019, I want us to go through the question number 4, part C. So November 2019, question number 4, part C. We check on page 25. When you go to page 25, that's where you have a question on the bond refunding and refinancing. It is question number 4, part C. So that question 4, part C, that question number 4, part C, you have been given details that Smooth Drive Limited, a motor vehicle assembly company, issued a 10-year, 16% shillings 100 million par value bond 5 years ago. 5 years ago. The bond was issued at a 2% discount and issuing cost amounted to 2 million. So due to the decline in the treasury bill rates in the recent past, interest rates in the money market have been falling, presenting favorable opportunities for them refinancing. A financial analyst engaged by the company to assess the possibility of refinancing the debt now reports that a new shillings 100 million par value 12% 5-year bond will be issued by the company. Issuing cost of the new bond will be 5% of the par value, and the discount of 3% will have to be given to attract the investors. The old bond can be redeemed at 10% premium, and in addition, 2-month interest penalty will have to be paid on redemption. All bond issue expenses, including the interest penalty, are amortized. They are amortized on the straight line basis over the life of the bond and are allowable for the corporate tax purposes. The applicable corporate tax rate is 40%, and the after-tax cost of the debt to the company is approximately 7%. So required, Roman letter 1, initial investment required to issue the new bond. Roman letter 2, annual cash flows or savings, if any, expected from the bond refinancing decision. Roman letter 2, net present value. Then Roman letter 4, advise the company on whether to refinance. So let us check the Roman letter 1, initial investment required. Want to see how to get the initial investment required for the refinancing. Initial investment required for the refinancing. So there are just 4 items we shall be discussing on that area to get the initial investment required for the refinancing. So to come up with initial investment required. So we shall be getting the total cost for you to replace the existing bond. So this is how to get the initial investment required to issue the new bond. Initial investment required. Initial investment required. Initial investment required for the refinancing. So there are 2 key items there we are interested in. One of them is normally the penalty you are charged when you repay a loan earlier than the expected period. So that term, we normally refer to it as the call premium. So the first element is the call premium. When you go to the paragraph number 3, they have said that the old bond can be redeemed at what percent? 10% premium. So the first item we shall be considering will be call premium. Will be the call premium. The call premium is simply the penalty you will be paying for repaying before the maturity period. They have said it is what percent? So it is 10% of the par value of the old bond. When you go to the first paragraph, you are told that the motor vehicle assembly company issued 10-year, 16% shillings. How much par value? 100 million. So we shall be getting 10% of the 100 million. So it is 10% of the, so the call premium it is the penalty they charge you on the bar value of the old bond for repaying earlier than the maturity period. So it is 10% of the bar value. So what is 10% of 100 million? It will give us 10 millions. There are 3 zeros at the top. Then another item is what in the notes they are referring to as overlapping interest. When you check in the notes in the note number 4, they have given you overlapping interest charges or expenses. So that is also another cost you will be incurring when you repay. So still where you got the call premium, they continued by saying that in addition, you can say in addition, 2-month interest penalty will have to be paid on what? Redemption. So we also now factor in overlapping interest. Overlapping interest. So that overlapping interest, it is on the old bond. In the first paragraph, you can see the interest rate is 16%. So it will be 16% of the bar value, but now it is 16% is per annum. We want only for 2 months. So after that, multiplied by 2/12 to apportion that for the 2 months. So multiplied by 2/12, because 16% is per annum. So 16% of the 100 million, but because it is only for 2 months, apportion that by multiplying by 2/12. So that will give us around which figure? I can say 2,666 point. So I have 3 zeros at the top, isn't it? So it will be 667 like that, because we have 3 zeros at the top. So that now will be able to give you the overlapping interest. Then apart from those two, there is also discount. Discount on issue of the new bond. Of the issue of the new bond. We incur discount to issue now the new bond. So discount on issue of the new bond, you got the paragraph number 2. We got the paragraph number 2, where they have said that due to the decline in the treasury bill rates in the recent past, interest rates in the money market have been falling, presenting a favorable opportunity for refinancing. A financial analyst engaged by the company to assess the possibility of refinancing has reported that 100 million par value, 12% 5-year bond will be issued by the company. So issuing cost of the new bond will be 5% of the bar value, and a discount of what percent? 3%. So it will be 3% of the bar value of the new bond. That discount is also 3%. So the bar value of the new bond in that paragraph is also 100 million. The bar value is still also given there as 100 million. So we get 3% of the 100 millions. We get 3% of also the 100 millions. So what should be 3% of the 100 millions? It is 3 millions. Then there is also issue costs. There is also the issue cost of the new bond. Issue cost of the new bond. So in the same area where we got the discount, want to compare which percent the issue cost for the new bond? You can see the 5%. It is also 5% of the bar value. The bar value of the new bond was also 100 million. The bar value of the new bond was also 100 million. So That should be able to give us which figure? So it's a 5 minutes. So when we add those 4 items, we shall be coming up with the gross cash outflow. We get the gross cash outflow. We come up with the gross cash outflow. The gross cash outflow. Yes. Yeah. Is it an income or a loss to you? It becomes a total cost for your business. So we are getting a total of how much? Sorry? Inakuja 20. Yeah, so after that, we need to less some tax on those costs. We need to less some tax. So we now less the tax. We minus the tax. Tax associated with. Tax associated with. So there are some items which I will combine all of those items together. I will combine all those items together before I get the tax on it. One of it is still that called premium. One of it still be the called premium. So I will combine all those items to be taxed. Then I multiply by the tax. Then I subtract. Because some of them that are there are not taxable. So we start with the 10 millions. I will start with this figure. Then also the overlapping interest. Also the overlapping interest. Overlapping interest, which is also 266.667. So there is another tax that has not been paid. There is another tax that has not been paid, which must be factored in on the old bond. So I want us to go through the question. You can see in the first paragraph, they were saying that the old bond was issued how many years ago? 10 years ago. Sorry, there was a 10-year, 16%, 145 years ago. So the bond was issued 5 years. But you entered into an agreement that the loan should be there for 10 years. So there are some costs that you incurred, discount and the issuing cost. Discount and the issuing cost on the old bond had been incurred. But now it has been there for the last 5 years. We still have how many years remaining? 5. So when you go through the question, they talked something about that in the paragraph, the last one, where they said that all the bonds can be redeemed at 10% premium, and in addition, 2-month interest penalty will have to be paid. All bond issue expenses, including what? Interest penalty, are amortized. Amortization is like to write them off on the straight line basis over the life of the bond and are allowable for the corporate tax. So now this bond has been there for the last 5 years. So the issuing cost and a discount on the old bond for the first 5 years has been written off. It means that tax has been paid. But now we have the remaining 5 years. It has not been what? Been paid. So it is in the books of their accounts. So we need to get the tax on that figure, because these costs are normally incurred at the initial stage. You see, when you give the discount to your customer, and also when you issue the bond, it is done before the payment is done. So it was paid. It was actually paid. So issuing cost was paid, discount was paid on the old bond. So they said that it is to be written off on the straight line basis. So the one for the 5 years has been written off, but the one for the remaining 5 years is still in the books. So we need to get that is still in the books. Then we get the tax on that element so that it will be able to be paid to reduce that particular total cost. So what we need to do, we need to get an amortized discount. An amortized discount on the old bond. On the old bond. We need to get an amortized discount on the old bond. So I want you to check in the first paragraph. What was the discount per annum? We get discount per annum. So discount per annum on the old bond. You want to calculate the discount per annum on the old bond. I want to get the discount per annum on the old bond. That discount is there in the first paragraph. It is there in the first paragraph where they had said that it was the old bond was issued at a 2% discount. So we get 2% of the 100 million, but divide by 10 years, because the old bond was supposed to be there for 10 years. The old bond was supposed to be there for 10 years. So get 2% of 100 million, divide by 10 years to see how much was being written off every year. Sorry? It is 200,000. So we get the 200,000. But we are looking for the one that has not been written off, isn't it? So this one is for 1 year. But how many years are remaining? Yeah, so to get this an amortized discount, now you get that 200,000 multiplied by the remaining period is 5 years, multiplied by the remaining period, which is meant to be 5 years. So we get an amortized discount on that old bond. So when you compute, you'll be able to give us how much? Sorry? Yeah, so I will put it there because it was paid, but tax has not been paid on it. Tax has not been paid on it. So it will be able to be factored in when we are looking for the refinancing at that portion. So we also have an amortized issue cost. Issue cost also on the old bond. We also need to calculate an amortized issue cost also on the old bond. Still in the first paragraph, you can see the issue cost. You have to get the issue cost also per annum. Issue cost per annum. So there they gave you the amount. The amount was how much in the first paragraph? It was 2 million. So this one was given as a value, 2 million. Also divide by 10 years. Also divide by 10 years, which is also supposed to be 200,000. Yeah, it will also give you 200,000. So we are looking for the one which is an amortized. You still take the 200,000, also multiplied by the remaining period. The remaining period is also 5 years. So that figure will also be the same as, so these four figures we multiplied by the tax rate. Those four figures we multiplied by the tax rate. It is an amortized issue cost on the old bond. So when we add them together, the tax rate was given as 40%. 40%. So multiplied by 40%, so that we get now the tax associated with those items. So the corporate tax rate was given as 40%. So we now get 40% of those lines. Then we record it at this point. We get 58. So now you less that figure. So we subtract this figure from that, so that you get now the initial investment required. So that you get now the initial investment required. So that you now get the initial investment required. So it will give you around which year? Yeah, so that should be now our Roman letter 1, where they were asking me to compute. They wanted you to compute the initial investment required to issue the new bond. Initial investment required to issue the new bond. So we go to the Roman letter 2. We now check the Roman letter 2. So Roman letter 2, annual cash flow or savings, if any, expected from the bond refinancing decision. So let us now compute the savings. We can now compute the savings as per the refinancing. We now also compute the savings as per the refinancing. So we now also come up with the annual cash inflows or the cost savings. Annual cash inflows or the cost savings, or simply the cost savings. That question. So I will be comparing the two bonds, the new bond and the old bond. So I will have the old bond, and also I will be having the new bond. So under each one of them, so I will be comparing the two of them. I will be comparing the two of them. So the first item will be interest per annum. Interest per annum. So the first item we are going to deal with is meant to be the interest per annum. So you want to compute interest per annum. So that interest per annum, we start with the old bond. That interest per annum, we start with the old bond. So in the first paragraph, it was 16%. It was 16%, 100 millions. So get 16% of the 100 millions. So that interest will be 16% of the 100 millions. So this one, we should be having it at that point. Then we go to the new bond. We also check interest on the new bond. So interest on the new bond, you also confirm in the second paragraph. You can see they talked about a financial analyst engaged by the company to assess the possibility of refinancing the debt. Reports that are new shillings how much? 100 million per value. What percent? Yeah, so get 12% of also 100 millions. You also get 12% of the 100 millions. So this one should be how much? It will also be 12 millions. Then now after that, we less the tax associated with less tax associated with the minus the tax associated with. The first one will still be the interest. Will be interest and the same figures that we have calculated, but now we put them under this column. Also, this will be 12 million. Then apart from the interest per annum, now there is also the discount per annum. Discount per annum. So discount per annum for the old bond. Discount per annum for the old bond. So remember in the first paragraph, it was 2% of 100 millions, but divide by 10 years because you want per annum. So get 2% of 100 million, then divide by 10 to give you. So this one is 200. Then we also compute the one for the new bond. We also compute the one for the new bond. For the new bond, you remember the discount was 3%. Yeah, so you get 3% of 100 million. But this one we divide by how many years? You divide by the 5 years. So that one we divide by the 5 years. We divide by the 5 years. Then, apart from that, also issue cost per annum. Issue cost also per annum. We also compute the issue costs per annum. So issue cost per annum on the old bond in the first paragraph, they gave you 2 million shillings. So you take the 2 million shillings, divide by 10 years. So this was still remaining 200. But for the new bond, it is supposed to be 5% of 100 millions. Also divide by the 5 years. Also divide by the 5 years. So this one should be which year? Sorry. So you get 1,000. So now I want you to get these 3 figures together, multiplied by 40%. We record it there. Also get these 3 figures together, multiplied by 40%. We also record them there. we also record them at that point. So we can first get this one, give me the value for this first one. $65. This one is 65, 60. Then also confirm for the new bond. Also confirm for the new bond. New bond should be reached here. Sorry? Hii inakuja ngapi? 50? Like that. So we are now subtracting this from that. We are now subtracting this from that. So that we get annual after tax costs. So that we get the annual after tax costs. So that we get the annual after the tax costs. So you minus this from that. Here, 9440. Now here, 65, 60 like that. So now we want to get the annual savings. So to get now the savings, you simply take 9440, subtract the 65, 60. So to get now the annual savings, you simply come up with that 9440, we subtract 65, 60. Inakuja 20. Yeah, so that is your Roman letter 2. That now should be our Roman letter 2. Then finally, there is also the Roman letter 3. We shall now be required to check Roman letter 3. So Roman letter 3, they were asking you to compute net present value of the refinancing position. They want you to compute the NPV. So NPV should be given by so we compute the net present value. So net present value is supposed to be given by, so NPV will be equal to present value for the cash inflows, we minus the present value for the cash outflow. So NPV should be equal to present value for the cash inflows, we minus the present value for the cash outflows. So I will first show you how to get the discounting rate. I will show you how to get the discounting rate. So to compute the discounting rate, it is simply before tax, cost of the new bond. Before tax, cost of the new bond. Before tax, cost of the new bond. Then we multiply by 1 minus the tax rate. When you want to compute the discounting rate, it is simply before tax cost of the new bond, then 1 minus the tax rate. So before tax cost of the new bond was the interest rate of the new bond. You remember the 12%? So 12%, 1 minus the tax rate. The tax rate was 40%. So interest rate on the new bond, remember we are getting 12% of that cost. That interest rate is what is the before tax cost of the new bond. That interest rate is what is meant to be the before tax cost of the new bond. So that figure was given in the question. Sometimes it may not be provided. Sometimes it may not be provided. So you are getting 7.2, isn't it? But check at the end of the question. You can see at the end of the question. At the end of the question, you are told that after tax cost of the debt to the company is approximately 7%. That's how they got the 7%, because this figure is 7.2. So approximately it has been rounded off to 7%. Just in case it is not given, you calculate it in that format. So we want to get the net present value. We are simply computing the net present value. So present value for the cash inflows. Present value of the cash inflows. It will simply be annuity. Present value interest factor for the annuity, 7% for 5 years. So annuity is our Roman letter 2. You can see our Roman letter 2, our annual savings that we calculated. We got how much? 28. Like that. So factor in the 3 zeros, which one? Then now check in the annuity table. What is 7% in 0.5? So we now check in the annuity table. So we confirm now in the annuity table, what is 10%, 7% in year 5? Sorry? 4.100. 2 like that. Yeah, so multiply that figure so that you now get present value for that cash inflows. So that you come up with present value for that cash inflows. Then you will be required to less present value for the cash outflow. So present value for the cash outflow is what we calculated in the step in the Roman letter 1. Present value for the cash outflow is what we calculated in Roman letter 1. You got how much in the Roman letter 1? Sorry? 14,800. So you subtract from that figure to get the net present value. We subtract to get the NPV. So if it is negative, then in the Roman letter 4, you advise them to refinance. But sorry, not to refinance. But if it is positive, we advise them to refinance. So is it positive or negative? So if it is negative, that's now our Roman letter 4. That's now our Roman letter 4. So Roman letter 4, we advise that they should not refinance the existing bond. They should not refinance the existing bond. They should not refinance the existing bond, as it will lead to a negative NPV. They should not refinance the existing bond, as it will lead to a negative NPV. It will lead to a negative NPV. So that is now all on that question. So we can stop there for now. So you try that. So you can go through the question and see how it will be able to work out. But that's the only question I've seen in that past paper about the bond refunding. So you can stop there for now. Let us stop there for now.